Good afternoon, everyone. Today, I'll discuss the key concepts of financial management, including its goals and functions, and how tools such as sensitivity analysis and capital budgeting helps organizations make informed financial decisions. I'll also explain how companies evaluate risk using both internal and external methods. By the end of this presentation, you'll have a better understanding of how financial decisions impact a company's overall success. The main goal of financial management is to maximize shareholders' wealth, which means increasing the company's value over time. This also includes ensuring the organization remains financially stable and continues to grow. Managers must constantly balance risks and returns, taking actions that benefit the company in the long term without exposing it to excessive financial risk. There are four key functions in financial management. Investment decisions involves choosing where to assign funds to achieve the best return. Therefore, the company decides whether it will make a profit from the company it is investing in. Financing decisions determines whether to use debt or equity, and dividends decisions focus on how much profit to return to shareholders. Lastly, financial marketable securities management ensures the company has enough cash to meet its short-term obligations. Sensitivity analysis is used to evaluate how changes in key variables affect economic results. This is especially important in capital budgeting decisions. It helps identify which variables have the greatest impact on a project's success and highlights potential risks before decisions are made. I will give you an example. Opening a small coffee shop. Expected monthly sales are $20,000. Estimated monthly cost is $15,000. Expected profit will be $5,000. A key variable, which is sales revenue. If sales drop to $17,000, a profit of $2,000 will be made. If sales increase to $23,000, then a profit of $8,000 will be made. It shows that a small change in sales can greatly affect profit. The sales revenue is a highly sensitive variable as well. The quantitative the quantitative steps begins with identifying important variables such as cost, revenue, and interest rates. Then a range of possible values is assigned to each variable. Financial indicators like net present value and internal rate of returns are recalculated using these values. Finally, results are compared to assess the project's sensitivity to change. Qualitative steps focus on non-numeric factors. These covers evaluating whether assumptions are realistic, considering current and future market conditions, and using management experience and judgment. External factors such as economic trends, competition, and regulations are also important in assessing risk. Internal financial methods are used to evaluate project risk. Net present value measures a project's profitability as well. The internal rate of return, also known as IRR, calculates the expected rate of return. Payback periods show how long it takes to recover the investment. Scenario analysis explains possible outcomes such as the best and worst case scenario. External methods focus on factors outside the company. Market analysis helps us understand demands and competition. Economic indicators such as inflation and interest rates shape financial decisions. Industry benchmarks allows comparison with competitors. Adjusting the cost of capital helps accounts for risk in different environments. For example, if I wanted to expand a retail store named Jen's Antiques, first a market analysis, you would research and have research shows declining customers demand in the area and indicate possible lower future revenue. Second, economic measures. Rising interest rates, increased borrowing costs, and higher inflation raises operation expenses. Third, industry benchmarks. Competitors have higher profit margins, which suggests that the project may be less competitive. Fourth, the cost of capital adjustment. Due to the higher risk, the required return increases and the project may no longer meet investment criteria. In conclusion, external factors can increase risk and affect profitability at my antique store, and even a good internal project can fail due to external conditions. Financial management plays a critical role in guiding a company's success by balancing risk and return. Effective financial management enables companies to adapt to uncertainty while maximizing value.